Word on Wall Street. Top investors watching your money this morning. Joining me now, First American Chief Economist Mark Fleming, Bulltech Capital Markets Chief Strategist Catherine Rooney Vera, and Michael Lee, Strategy Founder Michael Lee. Welcome, one and all. Catherine, let me kick it off with you. Michael, all eyes will be, and Catherine was talking about this, on the Federal Reserve's May policy meeting kicking off on Tuesday. The central bank is expected to announce a 50 basis point rate increase to fight this 40-year high inflation. But the Wall Street Journal headline from Nick Timrose says Fed prepares double-barrel tightening with bond runoff, talking about the portfolio. I think double-barreled is a pretty good phrase to use because the Fed's about to blow a hole in these markets if it hasn't already. But what are you expecting?
Yeah, so Dagan, the Federal Reserve is just like me in high school football, completely offsides. And when you're the center, that's a huge problem for your whole team. And when you're the Federal Reserve in charge of inflation for the U.S. economy and most of the world, it's an even bigger problem. And so we've been hearing that inflation is transitory. We're going to have a soft landing. And so the Fed is really between a rock and an extraordinarily huge hard place right now. I would expect 50 basis points coming out of this meeting, 50 basis points in the next meeting. I'd say the one thing the Fed has done pretty well is jawbone the market. And so you have Bullard out there saying we could go, months ago saying, well, we're going to go 25 and maybe we could do 5 hikes, then 6 hikes. And now the market's priced in about 10 hikes in the next 18 to 24 months. And then he's out there talking 75 basis points. I don't think we'll get 75 basis points. But if inflation does not slow quickly, this is going to get very, very ugly. We've had a tremendous amount of tightening already. In September, the 2-year Treasury was at 20 basis points. We started the year with the 10-year at 170. We got up near 3%.
Right.
Okay, this is extraordinary. This was an extraordinarily ugly quarter, not just for the stock market. And if you think about the stock market, we've been on a massive bull run since basically Trump won in 2016. That ended at the end of this year. So to give back 10 or 15% of 300 to 400% gain, depending on how you're invested, that's not a big deal. But bonds have done very little, and for the bond market to be down double digits in a single quarter is a shock many investors are just not prepared for. And to think that we're going to get some of the same, it's getting really, really ugly out there. And so if inflation does not get under control, you're going to have to take this economy into a very deep recession to crush the demand because there's no supply coming out of anywhere. And you only have 2 tools with inflation to either increase supply, create more stuff, or go ahead and decrease demand. And so the Fed's only option right now is to decrease demand. They've been trying to do that with talking out there, but I really hope we see this inflation's cut down and the Fed doesn't have to go as aggressive as they've been talking.
Before we move on to Mark, I'll just point out that the iShares 20-plus Treasury ETF, those are longer Treasuries, has lost almost 20% this year. It's a huge loss for somebody who was owning longer-term Treasuries. 44% of J.P. Morgan's most active Treasury clients are betting that yields will rise further. Only 22% betting that they'll come down. So there's more pain to come in bonds if you